Ladies and gentlemen, good day or good evening, wherever you may be. Thank you for taking the time to be with us today. My name is Khaitan, and I'm a partner in Khaitan and Company's corporate M&A practice group. I would like to extend a very warm welcome to this webinar to every one of you in this audience, whether from India or around the world. This is the first webinar in our M&A series over the course of 2021, and we look forward to your company over the course of the series. I'm very pleased to say that we are thrilled with the tremendous response we have had to the M&A series, with literally thousands of people taking up to our invitation to attend the series, not only from India but also abroad. We are grateful to the interest shown from our clients, associates, and others in responding to the invitation. On this slide is the agenda for today's webinar, or rather the order of events. In short, today's format will be a discussion between our expert panel, followed by a Q&A session with audience questions. We have already received several audience questions, and if you do have questions, please submit them using the facility provided in the webinar portal. If we cannot cover all questions during the webinar, we will respond offline by email after the webinar. Also, please note that a copy of the presentation and recording of this webinar will be sent to you after the webinar. This is the first webinar in the M&A series, which we explore how M&A deals get to first base. By first base, we mean the very first milestone in the life of a M&A deal, where the parties are agreed in principle and committed to the transaction, at least commercially, and on price and key terms. It does not mean that a deal will occur, because there are many other potential hurdles to a deal before it's closed, but it should mean that there is a sound basis for proceeding to the next step in the transaction cycle. This webinar is focused on the buy side only, so as to how a buyer should look at this phase in the M&A process, because we did not think we could do justice to both sale and buy sides in one webinar. We decided to start our M&A series here because every M&A deal goes through this process, and because both novices and experts are interested in how to get this milestone in the life cycle of a M&A deal. Novices want to know what to do as much as experts want to know why deals fail. Our aim is to give you an insider's view of this first critical phase in the M&A process from the perspective of expert investment bankers who do this for a living and have done for many years. As a result, you will get the benefit of their experience and their expertise honed over many years in hundreds of M&A deals. Every person who has registered for this webinar today has already received an email with full particulars of the credentials of our panel, so I will not spend time repeating or summarizing their experience. Suffice to say, they are all M&A experts with excellent M&A creds. We are fortunate today to have three leading investment bankers on our panel, namely Deepak Sharma, Managing Director, Mergers and Acquisition Advisory, Axis Capital; Sundareswaran S., Managing Director at Morgan Stanley, India, leading M&A Advisory, Real Estate and Consumer Banking; Karan Sharma, Executive Director and Co-Head, Digital and Technology Vertical of Avendus Capital. In addition, we are joined by my fellow Khaitan & Co. corporate M&A partners, Bharat Anand and Prasanjit Chakravarti, who are both very experienced M&A lawyers. So now let us bring in our expert panel members. I'll start with the first topic of acquisition team. And this is a question for you, Karan. how does one achieve the best acquisition team for each deal, and what factors are important in selecting that team?
Sure, thanks. Thanks, Agri. It's been a pleasure to be chatting here. In our experience, actually, what we've seen is obviously there's no golden rule here. However, one of the approaches that I've seen work better in more times than lesser is where we see a good culmination of deal pods being created, where we see a very dedicated deal pod for a transaction, largely led by a business sponsor, which could be a BU unit head or a CXO level person, depending upon the size of the buyer, the complexities involved. And in that deal pod, we've seen always is, along with the business sponsor, if we can have in-house corp dev or in-house strategy person, along with the legal and transaction support kind of a team member, I think those deal pods work the best because they're able to navigate through different situations in a very complementary way. They don't get, I would say, the process doesn't get over-indexed on just analysis paralysis in case it's just corp dev, which is almost a mirror image of a banker in a firm. At the same time, you don't lose sight of the bigger picture, which the business head needs to ensure that what's the core reason why you're doing this transaction. And in that evaluation, you get to see whether you can make the best from this acquisition. Whatever number crunching the teams are doing, does it make sense? Would you be able to get your paybacks? Would you be able to really extract the advantages or synergies that you started exploring that transaction in the first place for? I think that's a very interesting balance of a 3-4 member dedicated team carved out to evaluate a target and then take it ahead the whole process. And obviously, the more support they can get from external consults, external advisors, all that helps you smoothen the process. But I do believe this 3-member pod is what I've seen most successful in some of the transactions we have been involved, and it keeps the process going in a very smooth way.
Oh, that's very useful, Karan. And I would expect that you would, in that pod, also define roles and leadership and authorities within that pod.
Certainly, and I agree it's very important. The I becomes very important in these transactions as against we, because you need that I to take on both the responsibility and accountability over there, and that I should be responsible as against hiding behind this entire umbrella of we. And that is something we believe always has to reside with the business sponsor over there, because at the end of the day, they need to underwrite that transaction. So we've seen that singularity of ownership, accountability is key. And then obviously you are able to break down different pieces, be it the phase of commercial diligence, business evaluation, valuation workings, presenting to the board, all of that, the deal structuring, which some of these things we'll cover during this discussion. I think all those could be obviously delegated and they can be individually owned by different team leads. But it has to be the business sponsor who owns up to this in an ideal kind of environment. There are situations depending upon company structures, size, scale, where we have also seen the corp dev person, the corporate development team take on this ownership. Ideally, a BU head or a business person being a sponsor makes all the sense.
That is really insightful, Karan. Thank you. Maybe I'll move to the next section of non-disclosure agreements. Prasenji, this is for you. Why is a confidentiality agreement important? When should it be put in place? And who should sign up to it?
Well, I think it's a very interesting and important question. I think more often than not, what people think that, well, it's the seller who is disclosing all the confidential data because it has to open the books for due diligence, and therefore it should be a unilateral, one-sided NDA, which the buyer has to assume all the obligations. That actually is not accurate. A buyer also will on occasions share its data. For instance, if there's a shared swap element, a buyer will also show its financial wherewithal, that it has the capability to consummate the transaction, and therefore a buyer must, as a first principle, insist on a bilateral mutual NDA. So that's the first point I will wish to make here. It's also very critical that the deal terms, that there's a negotiation going on, if that is leaked, that can have adverse consequences on the buyer's stock market, stock prices if it's a listed company. And also its competitors will be aware of a strategy, which is not a great idea, isn't it, to let it know what you're planning to do. So mutual NDA absolutely must. Who should sign it? I think buyer will obviously need to sign it as the seller and the target. Also, the buyer will need to share the information which it gets of the target with its advisors. Therefore, the buyer needs to ensure that on a back-to-back basis, it has robust confidentiality agreements with its advisors who will get access to all the information, so that its buyer is not on the hook if the advisor drops the ball and leaks any information. So the advisors must also sign up to it. The third facet is the carve-outs to the obligation. If the buyer needs to share the information with its advisors or regulatory authorities, it should be allowed to do so, and it should not be hamstrung and keep on going back to the seller for its consent. Lastly, what is confidential data? Clearly, not anything and everything cannot be said to be confidential data, and therefore the buyer must closely examine the definition of confidential information. For instance, something which is public information, that surely should not be categorized as confidential data. If the seller wants a vague definition, the buyer should insist to make it watertight. Also define what is confidential when the information is shared, so that the buyer is not on the hook for an inadvertent breach of something which is not really confidential. So those are the three key big, I would say, points on NDA. The last point is on non-solicitation. Very often you will find that the seller will put in a non-solicitation obligation on the buyer, by which it will expect the buyer not to solicit employees for a certain period should the deal does not close. It looks from the face of it a good ask, a fair ask, but it's actually not such a fair ask, because a buyer and his HR team will not be able to keep track of any hirings and each and every hirings and breach of this non-solicitation. So what a buyer should try and do is narrow it down. And how do you narrow it down? Firstly, limit it to key employees, limit the duration to 3 months, 4 months at most, and also keep a carve out for any general solicitations. Let's say if the buyer's HR team puts out an advertisement to which somebody responds, clearly the buyer should not be in default for that kind of a breach. So I think that's a very critical point which buyer and their advisor should not overlook when drafting and negotiating non-disclosure agreements during the early stages of a transaction.
PC, that has been extremely useful. I think most often as buyers, we just sign up to the dotted line without actually realizing what we are signing up for. So let's move to some buyer issues, and I think it's good time to delve deeper. So Sundar, this one is for you. What are the major differences between different buyer types, and how are those differences manifested in different priorities for those groups?
Sure, thanks, Hagreev, and good to be speaking with you all. So, I mean, if you sort of simplistically look at the different types of buyer groups, right? I mean, you could broadly make it into two categories, which are the strategic buyers, who are largely existing corporates who operate in a certain sphere of business. And on the other side of the spectrum, you have financial sponsors or the private equity players, the sovereigns, etc. What we are increasingly seeing is, I mean, there was at one point of time a clear benefit or view that strategics in any process are going to be inherently much better suited to a transaction compared to the financial sponsors. Now, increasingly, both globally and even in India, I think that differentiating is getting narrowed down because I think even the financial sponsors, a lot of them now have global AUMs which run into multi-billion dollars or trillion dollars. Their portfolio companies and the ability to sort of leverage off those portfolio companies, etc. That's at play very well with the financial sponsors. So, but still, I would say, yeah, I mean, those are the two buckets, right? I mean, you have a strategic buyer on one side who intrinsically is sort of focused on what does this business do to me? I mean, what are the synergies it can offer? What is the product diversification, capabilities, technology it sort of adds to me? And on the other side, you have financial sponsors who are again sort of seeing it as, okay, I have this business which is at a certain scale, but me driving down the capabilities, this is what I can do. Now, increasingly, the asset management arms of each of these financial sponsors have become so active that the blur between the two to sort of say one will definitely be superior to the other sort of going away. And that's been sort of manifested through the processes. Having said that, I mean, when you still think about a process, if it's a add-on, tuck-in sort of an acquisition, there will still be areas where strategic is sort of better suited. The ability to drive synergies could be more, so there will be some areas. One fundamental aspect where I think these two buyer categories will differ is really when you sort of think about it from a strategic buyer perspective. I mean, the view is, I mean, they're not buying it with a view to buy and then sort of sell it over a single period of time. It's with a view to buy and hold more often than not. And then it's really whether the invested capital effectively earns higher than what my ROIC expectation is. And that's the sort of simple thesis. I mean, when people will do a DCF, etc. For a financial sponsor on the other side, I mean, they would have an exit horizon, call it 5 years, 7 years, 8 years, which sort of varies from people to people, which is the period within which they will need to make the decision. One aspect where, I mean, strategics could be meaningfully different is if the strategic is a listed company and they have the ability to offer stock, right? So if there is a cash versus a stock consideration, being a strategic, being a listed company adds that additional layer of flexibility. Now, from a seller perspective, whether the choice of whether they want stock, whether they want cash, etc. I mean, I think that would still continue to be a decision which is sort of individually driven. But I mean, that's the way I would sort of portray it. So clearly, each of the segments of categories of people have their own sort of areas which work for them, some which may not work for them. And sometimes it's also sort of important to sort of view it from the other side, right, which is from a seller perspective. And then when people are buying a company, one aspect is what is the company they are buying? What do they do? In a world which is constantly evolving, it's also the management team, right? It's important to sort of figure out how does the management team of the target come. Historically, I mean, whenever there used to be a strategic takeover of a business, the base assumption people used to say is, oh no, I mean, the jobs are at stake, the buyer is going to put their own people. That may not necessarily be the case. So there was a view that a financial sponsor is a better owner because I mean, they're going to sort of still continue with the employees. Now, all these, I mean, I would say over the last few years have increasingly got differentiated. I mean, people have realized that, I mean, employees still continue to be a key. Even if it's a strategic, I mean, they continue to sort of focus, take care of their employees. People are not buying a business to just not be looking at what's sort of beyond the core of the business. So I think that's the difference. But I mean, we are seeing a lot of things which sort of comes together to sort of suggest that differentiation is being blurred. The other aspect is really, I mean, the buyer groups, again, I mean, some of them have a preference to buy private companies, I mean, which gives a fair amount of operational flexibility going forward. I mean, you don't have to deal with a listed company, independent directors, quarterly disclosures, etc. So that's one part of it. Again, the buyer groups may have different views and preferences of whether they want a listed company or not. Again, I mean, there are always two sides to a coin. I mean, in a good market, it always helps to have a listed company, even though it may be difficult to sort of operationalize, I mean, full synergies, especially if you have the businesses, etc. But I mean, I think the share prices are good reflection, so it sort of counterbalances it off. The other area where we sort of again sort of find some amount of differentiation has come about is the buyer a foreign buyer or is it a domestic buyer, right? I mean, again, with time, I mean, I would say if you sort of go back maybe 10 years back or 15 years back, I mean, when the FDI regulations were even stricter than what it was today, then most sectors did have sectoral caps, which have progressively gone away. There used to be that differentiation, which was even more meaningful when you think about a global buyer versus a local buyer. I mean, today, I mean, when you look at it, there are probably a handful of sectors, including insurance, where there may be sort of restrictions. I mean, when insurance was sort of opened up more yesterday. So that, again, sort of goes away. But there are a few added complexities which a foreign buyer will have to sort of keep in mind, which is there are pricing regulations. I mean, eventually, if they want to sort of sell the business, there are certain pricing caps which will be applicable if they want to sort of sell a business to a domestic buyer. But beyond that, I mean, the considerations pretty much the same. I mean, I would sort of go on to say we are at a point of time where across most sectors, the ability for a foreign buyer and a domestic buyer to compete on a level playing field, the ability for a strategic and a financial sponsor to compete on a level playing field, all those are sort of coming together, which in our view it continues to augur well for the industry, and which is really what we sort of look forward to. It helps promote a very healthy environment for M&A activity in the country.
Very interesting, Sundar. Actually, quite a learning how, you know, on the one hand, all these differences are blurring and everything is merging. On the other hand, you still have certain subtle differences which you need to strategize. And who better than you with your trailblazing deals last year, you know, where you could actually get strategics, financial sponsors all on the same table. I'm not going to mention the deal, but you know, everybody in the country and internationally was in awe of what you've been doing actually. So congratulations on that score. So moving on, you know, I'll come back to you, Karan, before getting to Deepak. And on the sale process, let's talk a little bit about the sale process, Karan. How does the sale process change with deal dynamics? Can you describe a little bit? So when you're looking at maybe, you know, bilateral deals or auction deals, how do you see that changing? If you can talk a little bit about that, Karan.
Sure. Sure. So I guess this is one aspect which is not solely in the hands of the buyer. I think this is a very interesting one. You know, it's a model where you need to see what are the trade-offs you're willing to live with. The trade-offs could be in different sets, could be optimizing for certainty vis-a-vis the cost, which is valuation, could be speed as against the depth of diligence that you can achieve. So we do believe, you know, be it a bilateral discussion or a typical M&A auction, which a seller might prefer, to a great extent, the process design is a little bit of a factor, you know, determined by the seller. Having said that, there are opportunities in case a formal process hasn't set up. There are opportunities for a keen buyer where they believe, where they have done a lot of outside work, where typically they might be in the similar industry. They know the counterparty very well. They have tracked them for a while. They broadly know the numbers, or they know the business so well that you give them one metric, they can pretty much build the entire P&L for the other entity. I think in those cases, there's always an advantage if you can, you know, pull off a bilateral discussion. And even if it means at the cost of getting into a binding agreement and making a preemptive strike by offering maybe a value at that point of time that you might believe is more than the market. No one knows the market price, right? You know, because they haven't really engaged with multiple people. So I do believe, you know, a bilateral deal in the aspects of the parameters I defined could be very interesting. It also gives businesses more opportunities to engage, think a little more open in terms of what future might lie in case it's a merger, or in case the management team or the founders are looking to continue for a while. That environment is a little more suitable for for these discussions on how together value can be created, value can be unlocked, how synergies could be really exploited as against being under the deal pressure. And some of those aspects we've seen in bilateral come out more beautifully as compared to a very transactional, cold-blooded auction. So that's our view. And in some situations we have seen, in case parties are not able to come to a conclusion on how they want to engage, a hybrid also works very well, where you maybe start with a multi-party approach to really define the first level of diligence completions, business, commercial, some of those aspects being taken care of, where you arrive at the entire commercial construct, where you're able to ascertain the tax part, structuring part very clearly, and commit that this is a path you're going to take on taxation, on structuring, and you have a fair bit of sense on what valuation would be, what adjustments would be, and what kind of holdbacks or escrows you're thinking about. I think if you're able to do that with 2 or 3 people in the beginning, and basis that you're able to shortlist and then take one in almost like a bilateral fashion. So a 2-step kind of a process could also address a lot of concerns that the sellers might have. And they also end up addressing almost, be it a seller's remorse or a buyer's remorse of having just engaged one-on-one. So I would say hybrid is interesting. However, if the parameters of being in the same industry, you know each other very well, for a buyer, a recommendation could be to step up on value and try and do a preemptive strike and get a bilateral going. Obviously, this would really vary. The process design would really vary in every situation. And I would say this is really the crux of how, what is the tone you're going to set for the rest of the process and the conversation. So yeah, it's a pretty interesting, I would say, a fork in the road that comes for both sides. And it's important that they're able to, discuss this between themselves, really bring about the trade-offs, the advantages, as well as the fallout, challenges, and take a decision. It's a very interesting kind of a topic in any M&A process.
Very interesting, because more and more, we are seeing that bilateral deals are really far and in between now. It's really run through processes, and as you said, might get to a hybrid. Is that your experience as well?
Yes. So we've seen, especially, and because we work, on both sides, on the buy side, sell side, very equitably. We have seen just the comfort with engaging with multiple parties, even though in your mind you know that this is my priority one, and this is the one where I will engage the most and take it to conclusion. Everything else, falling in place. Even in those situations, I believe having 1 or 2 other people in the mix keeps both sides honest, and that that ensures there's some level of intensity, there's some level of guardrails in place that pushes both sides to really bring their best out, right? Best out in coming to conclusions faster, running the processes efficiently, forces them to take certain decisions in timely manner. So I would say a hybrid is becoming more and more of a norm. At the same time, I think auctions are limited to very like full-blown large auctions are limited to very few situations now. So I think hybrid is a good kind of a way to address both sides, making it a 2-step, 2-3 parties to begin with, 3 parties to begin with, and then you just almost take it to conclusion in a bilateral fashion.
I think that's really honest advice. So moving to you, Deepak, let's talk a little bit about target diligence, valuation, and bid strategy. So when you are given an acquisition mandate to develop an acquisition and pricing strategy, how do you really prepare, and what are the most important steps that you need to take?
So thanks, Agib. I think it's any M&A process. I mean, it's very difficult to say whether we can take a standard approach. So really speaking, at one level, you start off with where the client is in his thought process. So there are people out there who have done M&A now several times over the past, let's say, a couple of decades. Few of the business houses who have been very active, they tend to be very clear in terms of what is required from an M&A. Why are they going out and doing that M&A in the first place? And then there could be some up and coming, it could be corporates, it could be business houses, it could be individuals as well, who are going out and seeking M&A as a growth avenue. Now, I think for the former, a lot of the questions are answered, and the latter, we actually spend time in terms of trying to understand what is it that they're trying to achieve through the M&A. So, I mean, it's always a build versus buy call, in most cases, and you need to, get into this whole justification of what are the parameters and why you want to go through M&A and not the organic route. That's one fundamental question that most promoters struggle with at some point during the M&A process, for sure. The other kind of things, are you seeking customers? Are you seeking market diversification, IP? As Sundar and Karan both pointed out, acqui-hiring now. If you're actually going out and trying to get the key managers into your fold, and that's the only way to do it. There could be all these factors that have to be brought in. Second aspect that you need to think through very carefully is, from M&A perspective, is it a majority, minority, complete buyout? What is it that you're comfortable with? And are JVs the way for you, or are you really looking for being the sole captain on the ship, kind of a thing? So those kind of things. And then the other element is how are you going to pay for it, right? Stock versus cash. What are the preferences that you have? And it may be driven by your own balance sheet position, the way the market is panning out at the point in time, the way the valuations stack up from a cyclical perspective over a period of time. So all those things come into the fore. So you have a set of criteria that you lay down jointly with the client and have a clarity in terms of what are the top 4 or 5 items that you want to tick off. One of the funny things that you realize after you do M&A for as long as all of us have done, is that perfect targets don't exist, right? So you have to compromise at some level. You'll go up to, let's say, you could be maybe 80% there, 90% there, even potentially 95% there. But there's always that element where you say, okay, what is it that I'm willing to give up? And then still go ahead with the transaction. And that's again a big call because, and that has to be a joint sort of an effort internally. It's more a lot of soul searching required for that, because M&A by itself is so impactful, and it is a senior management game. It's not as if you can delegate it down. So it's the senior or maybe a board level or a promoter family level decision, and everybody comes to the table and agrees on what those criteria are. So once those criteria are sort of set, then you go out and start scoping in the market. You use your networks, and the other thing that you realize very quickly is that the best targets potentially don't want to engage, because they're doing very well themselves. I'm not saying that there are not situations that very good targets have gone on the block, but it's a bit of a luck factor playing out. More often than not, you will have issues where there are gaps out there which they have not been able to meet, or there are succession issues. There could be other criteria which are driving that. So you have a set of targets, you have a set of criteria, so you try and match, and build that metric out and say, okay, based on this, what is it that sounds more attractive for me? And mind you, we are all staying internal at this point in time, because you can't be going out and with a half-baked thought process be approaching potential targets and talking to counterparties. It's a very sensitive matter at the end of the day. So you're doing all of that, and once you've done that, you essentially then get into the first thing or top of the mind is the valuation analysis. Of course, it's an outside in, so it tends to be more driven by comparable situations, trading comparables, transaction comparables, or you understanding the market. To the extent it's listed, you may have some analysts covering it, or like Karan pointed out, in some cases there are some companies which are well understood. So you sort of use those as benchmarks and move into that. But I think the other aspects which become very, very important are the other factors that you need to think. In terms of synergies, for example, if you're going out and really looking at a target, what is the synergy that you're going to draw out of it? That becomes a very, very important aspect. What is the value that you're getting out of it? If you're paying fair value, you should, for every 1 rupee, you should be making at least 2. That's the way any promoter or any buyer should be thinking. The other part is in terms of the whole source of funding. We talked about, I touched upon cash versus stock, but also the impact of a transaction on your balance sheet. How does that work from the buyer's perspective? investor perception of the transaction can be very important. You may be going out and doing a very good transaction in your own mind, but what does if you are a listed buyer, you need to be very mindful of that. So those kind of aspects, the softer aspects, start coming into play. Regulatory aspects like antitrust, those are things which where I mean, we are maturing as a market on the antitrust front now, but still there are enough questions out there, and the way the interpretation of antitrust and CCI is sort of changing its views. All those things have to be brought in, and I think their bankers and lawyers actually play a very key role in terms of sifting through what is not possible regulatory wise, and playing that out in that fashion. And I think, eventually what it comes down to is that before you go out and start tapping into the external world, in external targets, in terms of external networks, this whole aspect of having thought through the various parameters, and also how this will look and how you're going to handle it post transaction, because a lot of times people tend to not be very conscious of the obligation that comes on the management team in terms of handholding and integrating a target in. So all those aspects, being mentally ready. I've had instances where great targets, bang on strategy, and then you sit down and think, who's going to manage this? If it's a succession, for example, and very quickly you come to an answer, no, it doesn't make sense, and you need that guy. Or you then take an alternate approach and say, okay, these are 3 guys I definitely need, I need to bind them in. So all those things are all coming together. And then, the other thing you of course do is that when you're going out, the reputation of the management team of the target, the diligence issues that you perceive will be coming through, that becomes a key criteria in terms of your liking of the target and the strength of your conviction. And then once you have set the ball rolling, once you have made that approach, it's in the public domain. I mean, we may talk about NDAs and we may talk about other things coming through subsequently, but the fact that you expressed an interest on a potential target is a very, very material event for any buyer as well as a seller. So to that extent, I think, all these come into it. It's a very wide list. You don't have a set formula, but I think as you go through these processes a few times as corporates, they have their own conviction levels coming through. And for guys who are starting off afresh, I think the role of the advisors is even more critical, and we do help. We do the hand holding and the soul searching part for them to some extent.
Intriguing indeed. So as that M&A deal is cooking, I think it's time to get the lawyers in. So Bharat, over to you. Let's talk a little bit about key deal terms. How do you decide on key deal terms on first base? If we can have some of your thoughts.
Well, thank you, Agreev. And really, I'll take off from where Deepak and Sundar left, which is that you have to decide what is the most optimum way of achieving the objectives of the buyer and the seller. And really, optimization as opposed to maximization is is a key principle. And some of the questions were already asked. Are you buying 100% of the target? Are you buying a business? Are you going to merge your company into the target company and cancel shares? Will you the target into your company and issue some sort of a redeemable instrument? And all of these types of issues that come up in terms of transaction structure, which is the key theme in terms of first base, needs to be thought about, and needs to be thought about quite early. And I think intellectually it's probably the most challenging domain in the transaction arena. And especially from a lawyer's and from an external advisor's standpoint. But there are conflicts, because when you're planning this transaction structuring, as often happens in our roles, your litigation partners and the people doing will tell you that, look, the target has just received a major tax notice, so there is a huge litigation. You should not do a share deal, do an asset deal. You start thinking about asset deal, and the real estate team will tell you that, look, if you want to transfer the real estate, all the leases are subject to some consent requirement, and the leases will be renegotiated, and there is stamp duty, and then there is transfer charges, and then somebody from the compliance side will tell you, but there are 1,000 approvals to be obtained, and getting those approvals will take a lot of time. So people then think, okay, someone from the tax team will tell you that there is carry forward of losses, so actually we should try and look at merging the target. And so there are many conflicts and many challenges, and all of this needs to be reconciled. in an efficient manner. But clearly at first base, having a very clear idea, are we doing a share deal or an asset deal? That should be very clearly set out, I think, in the term sheet so that people have an idea of what they're going into. Also bear in mind that at this stage, all the planning will not be done. The tax teams will be doing their work. The internal business and accounting teams will be doing their work. The legal guys will be doing their work. But should the buyer forego the opportunity to enter into a term sheet? I don't think so, because I think actually what happens is once you sign the term sheet, you have a moral commitment to go ahead, and hopefully you have some sort of indication of price at least, and so really you have then a commitment from a seller to take you to the path forward. Now it could be the hybrid model where you're taking a few people forward. It could be the bilateral model where only a couple walking down, two parties walking down the aisle. That doesn't matter, but the fact is that you're advancing. So just because the work isn't complete doesn't mean that if you are advising the buy side that one should forego the term sheet. And I guess lastly, I would just add that it's also important if there are any carve outs. I mean, if you're buying an entity and you want to do a share deal, but they have a joint venture interest, and you don't want to acquire that interest in the joint venture, so at least some early identification of what is not included is important. And I suppose lastly, at first base, it's also important to ensure that if there is a particular tax slant or a particular regulatory slant that that we wish to achieve sort of backward looking, then the initial documents should be drafted in that manner and not subsequently rectified at the definitive stage, because then it looks like an afterthought. But that's really what I would suggest in terms of first base.
Bharat, I think you've safeguarded the lawyer's role well, even at first base, with your detailed analysis, I should say. So Sundar, before we move on, Bharat touched upon term sheet, and I'll come to Deepak in a moment as to why a term sheet is required at all. But before we get there, can you give us a few of your thoughts on how do you agree to the key deal terms with the seller? Some insights before we get to term sheet.
Sure. So I think from a key deal terms perspective, right, I mean, as everyone is aware, at the front and center of it all is the price, right? I mean, that's what everyone spends days and hours sort of discussing it. Now, I think the one point is, I mean, I think when we sort of think about from any deal perspective, buyer, seller, whoever it might be, in our view, there are three parts to a deal, right? I mean, which has to make sense. I mean, one is the price, the second is the certainty, and the third is the speed at which it can be completed. And typically, I mean, people spend enormous amount of time on the price, which is absolutely fair. That's what people are sort of really sort of focused on. But the other two are equally important, and some of it probably has a way to sort of even play into the price point, right? I mean, if someone can move faster than the other, I mean, the price can be different. If someone takes 6 months or 12 months to complete a deal, even at a 10% cost of capital for 6 months, it's like 10% difference in the price. And the price you might have foregone could actually be different from that. So I think the way we sort of think about it is, does it meet all the objectives of a price, speed, certainty? And price and the headline sticker price, typically, I mean, for a seller becomes absolutely critical. And from a buyer, I mean, either you get to the price, hopefully you get there. If you don't get to the price, I mean, are there ways in which you can be creative and try to get there, right? Many a times we have seen what people really focus is on the sticker price, right? And sometimes people do a little bit of deferred consideration. You get to the headline price, but from a time value perspective, you're sort of slightly better. The second could be, I mean, okay, give a price, but I mean, can you give in a little bit of carrot in terms of allowing the seller to ride a little bit of upside alongside you? Maybe let them continue to have a smaller stake in the company, ride the upside with you. And there have been sort of numerous examples where it has sort of really played out well, where someone is selling a business, but there's a sort of retained a small stake and they rode the upside with that. So when we think about it from a buyer perspective, without diluting the fact that price is important, I mean, we also try to see, I mean, how could you sort of make sure that people get a full perspective on the price, which is there's a benefit to speed, there's a benefit to certainty, and there's some potential upsides you could sort of get there. So we sort of try to focus on each of these. And from a buyer perspective, the other key aspect is, I mean, Bharat has covered everything, but I mean, just from a business perspective, when you're taking over a business, typically there will be a few things which are important to sort of make sure you're sort of running the ship fine going forward, right? Which could be in terms of transitioning services or continuity of the management, etc. So you need to sort of just make sure what you need to make sure that you know how to run the ship for the next 6 to 12 months before you sort of completely take over is also clear, right? I mean, so some of those things, it's better to be clear up front, clarify it, let them know, and sort of take it.
Fantastic. I think extremely useful. So that brings us to term sheet. You know, Bharat spoke about the term sheet, Deepak. Why do you really need a term sheet, and when should it be put in place? What's your view?
Well, to my mind, I think the term sheet is a fairly fundamental document. I think it's really, you know, as Sundar was just saying, there can be a lot of discussions which really result in a term sheet. And at the term sheet stage, what you're doing is for the first time actually formalizing everything on a piece of paper. And as we have all realized, not only in M&A transaction, but in quite a few facets in our life, once you start bulletizing what are you actually talking about, there is a lot of revelation that happens to yourself and to the counterparty. So I think to that extent, it's a very, very important document. And I think to some extent, what we as M&A practitioners have also realized, and let's rewind back maybe a decade or more, and we'll see that, at that point in time, a lot of these things were done at, two promoters have spoken, and they have, sort of related down to the teams, and the teams are interpreting things and, trying to make things happen. It used to happen in that fashion. I think along the way, we've become more structured, and we've realized that clarity has its own value. And early clarity at that is even more valuable. Because what it does is, first, the moment you sit down and say, okay, what are the elements that we want to put in the term sheet? And some of the elements which Bharat and Sundar just touched upon, they become very important. They come to the fore. And you start thinking about those and start, sort of, how should I say, getting them involved into the tapestry right at the beginning. Don't want to weave it later because it won't look nice at that point in time. So getting that smoothly into the process is very, very important. Getting it early into the process, what it does is it gives a lot of discipline to the process. As a buyer, what are you committing? I mean, a term sheet will typically have the broad commercial terms. It'll have a timeline. It'll have the due diligence, in quite a few places. We'll also say what kind of due diligence we'll carry out. And we have seen instances where due diligence checklists have been attached. So you can have various amount of detail that the term sheet can go into. And most of these are annexures, so people don't really spend time in terms of reading the annexures, but at least in circumscribing or putting a parameter around it, it becomes important. And because you're taking on that obligation of achieving something in a finite time, that means as a buyer, you have done a lot of groundwork at your end. So that, because what will start happening thereafter is, until that point in time, you're dealing with a very select set of close advisors. And internal management. The moment you get into a term sheet, what it means is that you're now engaging external advisors. The cost element starts playing up. Till that point in time, it's the effort part, which is the predominant part of what you're investing. But now the cost element starts coming in, which essentially means you're going out and going to get your corporate approvals. You're going to your board members, you're going to your promoters, you're building a case, you're presenting a case in a robust fashion. And then, all those elements will be woven into the term sheet. From a seller perspective, clearly, because valuation will be one of the key parameters that the seller is looking at. So you have done your base analysis on the valuation. You may, I mean, of course, it's very difficult to come with a specific number in most instances, but you'll have a range and say, okay, subject to due diligence, this is what I'm going to get at. Sellers' expectations in terms of, at times it's more than just the commercial or the price part of it. There could be other elements here. There could be roles for the key management. There could be roles for family members, or the desire to retain. For example, real estate is a classic, where most people have this view that I'm sitting in the middle of Gurgaon, I have this plant, and the real estate is worth so much. Is there a way of structuring that out? And you suddenly start realizing, well, he's not talking about a going concern business alone, but also the underlying asset value. So all those things start coming out. And then you start, putting those structures, appropriate structures to the extent you can, and then try and find a mechanism around it. I think really speaking, from an overall perspective, the other thing which is very important is that the term sheet has very strong reputational connotations. Yes, the fact you went out, you approached somebody, you had informal dialogues, but that's still maybe a handful of people on both sides. The moment the term sheet has happened, the tent gets wider. So many more advisors get to know it. So many people get to know it. And to the extent a buyer or a seller changes his views after the term sheet has been initialed, that becomes a very tricky point from a negotiation standpoint in the process itself. Or you may start carrying the reputation that he as a buyer, for example, that he shows interest in a lot of places but is not able to follow through, which means the next time, after doing this 2 or 3 times, the fourth targeted approaches becomes very difficult for him to convince him that you're very serious, and more than your seriousness, you have the ability to carry it through. So I think all those elements play out, and the fact that with so many people getting know about this transaction, chance of leak, the fact that there are elements and price sensitive information going out in the market, all those things start playing out. And I think in a nutshell, what will happen is, I think Bharat had summed it up quite nicely in terms of what is the potpourri you want in the term sheet. But I think the way I simply look at it is that the term sheet is actually the foundation on which the entire definitive documentation will start building up. Typically, you would not have all the worst case scenarios, all the events of defaults, built into the term sheet. You will have the base case scenarios and the good parameters that you want to achieve, which will be enshrined in the term sheet. And then the spirit of that will allow you to also negotiate the tricky ones on events of default, on the indemnities and reps and everything else that comes in, and which are a lot more contentious in terms of negotiation, rather than the good spirit in which you are shaking hands and saying, okay, let's embark on this process together. If it involves costs from buyer, it involves costs from the seller, it involves dedication of time, let it all go from a wider team from here on. So I do believe that having a very well thought out term sheet at times define the possibility of success in a transaction process to a very, very significant degree.
No, thank you, Deepak. Bharat and PC, a question for you. Should a term sheet be binding or non-binding? And part 2 is, if so binding, what provisions should be binding and why? I know we're running out of time, but a quick question. This will be very useful. This comes up in virtually every M&A deal which we do.
Well, I think if I can go first, I think on the binding, I think non-binding piece, I think ordinarily our term sheet is non-binding in nature, except few provisions, and there are good reasons for it. Because term sheet is not a stage where you get into nitty-gritties, a lot of nuts and bolts and details. It's more of a big picture transaction document. It's not really a document of detail. And therefore, it's better to keep it non-binding. Of course, you need provisions like exclusivity for the buyer, without which a buyer is left hang out to dry if the seller goes on and shops around the offer which the buyer makes. So buyer needs exclusivity, that has to be binding. To give teeth to that, you need your governing law, confidentiality, which is also binding, the dispute resolution mechanism. These handful of provisions are made binding. But barring that, I think it's commonplace to have the rest of the terms discussed at length, but keep it non-binding. That's what I would recommend, at the outset of the transaction. Bharat, do you wish to add to that as well?
That's perfectly summarized. Thank you.
So thank you very much. I think we are getting to the end of our session, and before we take the audience questions, I'd like to ask all of you, to answer this, perhaps each one of you to give your views on common buyer mistakes. What are the most common mistakes buyers make in getting M&A deals to first base, and how should they be avoided? So maybe Karan, if you can go first, and anyone can go in whichever order, it'll be very useful. First base mistakes.
Sure, I agree. So I think one of the things we have seen, especially on the tech side, and maybe in particular even more consumer tech, is that even though the business case for an acquisition is made, however, one thing I've seen is that not a lot of thought process is given on a very tight game plan towards post acquisition integration. And it's very intuitive, but we've seen in consumer tech especially the integration times for businesses to merge into, platforms to merge into, consumer bases and the brands is much longer in consumer tech in my own experience. And you've seen these brands that large buyers end up acquiring, they are just still operating. By brands I mean these are .coms and apps, still operating independently for years and years together. Energy is not being milked at all. Maybe it's got to do a little bit of what is the cost of capital. Maybe because your value creation as a tech company, your growth is much faster. Maybe the capital is cheaper. Maybe to make it happen or make it work, that pressure is lesser. Maybe compared to some other industries. However, I've seen not a very good thought given to having a very tight game plan and including that game plan into the definitive documentation on how a time-bound integration has to happen and what are the milestones over there to make that integration done in a time-bound way, and if there are any incentives or disincentives put around integration. Some of these things I believe are especially in tech industries is a mistake I've seen made quite often.
Very useful. Any other insights, Sundar, Deepak?
So I'll just come in and one aspect that people tend to underestimate is the amount of time commitment that's required from the senior management, and at times it could very well mean the promoter or the CEO himself, because the impact of M&A transaction, and they can be bolt-ons, the small ones which are happening, and let's say the IT companies like Infosys and TCS and HCL do multiple transactions in a year, but that's a well-honed machinery. But in general, if you're talking about a transformative M&A, the level of involvement that's required from a senior management is humongous. And at times you end up committing to some amount of timelines, or or you talk about processes without necessarily having a sense of the depth that you need to go into. And because all that is happening in quick time, you feel rushed and you get yourself into a time pressure. And the worst thing you can do in a negotiation is get into a time pressure when there are other elements that you need to think about. So I have seen that people underestimate that part, and to that extent, may end up compromising on the outcome. And that's one thing which, as bankers and as lawyers, we have tried to make our clients conscious of. But that's one thing people do underestimate, because it seems very simplistic that yeah, we'll do negotiations over 2 days and we'll close it out. It doesn't happen that way.
Indeed. Sundar, any views?
Yeah. I think the only thing I would sort of add on is, from a buyer perspective, I don't think there's a fixed rule when it comes to the counterparty. Every counterparty tends to be unique. And sometimes, you might have a very sophisticated counterparty who reacts to your views in 24 hours, 48 hours. But at times, there may be counterparties who take weeks to respond to it, right? People may have to go back, promoter, family, larger family, etc. So, you need to be sort of prepared for it. Sometimes, no one likes it. What is agreed sometimes tends to change. You think something is agreed, but then things could change. Those are things which, no one likes it, but sometimes you just have to be sort of prepared to sort of deal with some of those uncertainties. And the fact is, the seller universe could be different. There could be different ways in which the response time of the buyer doesn't necessarily correlate to the response time of the seller, and one just needs to be prepared for that.
That is really good practical advice. Bharat, your last word before we get to the audience.
Just one, in my experience, what we've seen in terms of common buyer mistakes is sometimes the buyers spend too much of time at the term sheet level, getting into a lot of detail in terms of consequences of default, etc., which may not be term sheet level stuff. And so when the parties are really getting a feel of each other, you scare away the counterparty. And on the other hand, sometimes buyers spend too little time and they don't realize that it's not a bilateral process, it's more of a hybrid process, the model that Karan spoke about. You're taking 2 or 3 people down the aisle with you. And in that situation, the seller has a lot of leverage and they rush into it without really realizing that the seller has then locked them into a position. So I would say really achieving that balance and being objective is very important.
Oh, thank you. So I'll get to some of the audience questions. So let me see what we have here. I think we have a set of very interesting audience questions. The first question is really from Mr. Dhruv Khaitan. What is the near-term potential of SPAC deals for Indian companies on fully Indian or cross-border cases? So maybe Karan, do you want to take that? How do you see that?
Sure. I think SPACs and tech go hand in hand. So our perspective today is that for Indian companies which are serving global markets, easier than companies serving domestic markets, or in industries which are well understood, especially in the US, it makes more sense. So our view is, be it enterprise software companies, SaaS companies, to some extent technology companies serving, say, payments or gaming or digital content, which are more digital delivery kind of products as against hardcore on-ground operations. We believe these are the companies which are more suited to leverage, if they have to, the entire SPAC route to become public in the US. And actually, these are kind of companies also which are appealing more to the investors over there or the SPAC managers over there. Our view is, this will take a little bit of a time in terms of 1 or 2 have to happen before the so-called floodgates open. Maybe 1 odd can happen. This year in the past 3-4 transactions have happened. They haven't been the most kind of a promising months in terms of creating public market liquidity. However, the times have changed, right? SPACs are not seen in the same light as they used to be earlier. So my personal belief is the first set would be more in the software, SaaS, a little more global or digital delivery kind of businesses that will leverage it first.
Understood, Karan. I think then we have a question from Mr. Bhualka, and maybe Bharat, you can take this. Can you tell us when it is the right time to go for an asset deal as compared to a share deal? You could give some comparables and where it's the advantages and disadvantages. I don't know if you've lost Bharat. Maybe PC, you can take that up. I think there's a internet problem.
Sure. So I think asset deal or share deal is really driven by the commercial objectives, the strategic objective. And if, for instance, a seller has a portfolio of assets and the buyer is only interested in buying one particular asset, naturally a share deal will not make sense for either parties. And it's better that the seller carves out that asset and transfers that into new company where the buyer invests. So that's a tailor-made situation where asset deal makes absolute sense. Likewise, if a buyer during the due diligence identifies some unwanted liabilities, which is absolutely non-starter, doesn't want to assume, then obviously, and buyer will insist that let's carve out and cherry pick these assets, extricate these liabilities, and an asset deal is possible. In contrast, if it's a target company with just a solitary business and really the business health is not too bad, and the share deal absolutely will be tailor-made for that. It's less complicated. An asset deal is far more complicated with innovations and consents and approvals. And if it's a merger, then it's even more time-consuming because of the NCLT process. So really depends on the commercial objectives, strategic objectives, and the health of the company. I think those will be the driving factors to decide whether a share deal or an asset deal or a business transfer would be better.
Well, I can see from the audience questions that they're really astute lot amongst our audience. I'm going to take a few more and then I guess we'll run out of time, but to mention to the audience that we will be answering all your questions on the email after the session. So very interesting question. Maybe, Deepak, you can take this. At what stage in an M&A transaction would you consider purchasing a W&I policy, and is this recommended? Are bankers now recommending W&I insurance?
So I think this is one of the more recent practices that have made it to the Indian shores. Of course, internationally, it has been a well-accepted practice, and there are of course costs involved. So Indian promoters tend to always wait in that fashion. But I think in a particular instance where financial sponsors are involved, for example, and they have limitations in terms of what kind of reps and warranties can they be giving out. I think the indemnity protections become very, very relevant in that case. So from an overall perspective, I think particularly where financial sponsors are sellers and there are funds which cannot really be standing behind and providing those protections, or if a promoter doesn't want a holdback or an escrow amount to be sitting out there. So all those cash flow retentions can be avoided. But then the other case, if it's a well-governed company where there is a promoter and there's an entity of substance, as we like to call it, which is going to be there to stay behind and fulfill the obligations, the promoters may very well feel quite comfortable taking on those obligations and not really feeling the need for it. But I think it's essentially a choice where you're trying to sort of segment the liability and say, okay, whether I have any legacy issues coming out of a transaction or I'm taking a clean break out of that. So it's to that extent, I mean, I would look at it in that fashion rather than and from a buyer perspective, it does work in the case, for example, some of the problematic assets which Prasenjit talked about. If there is a way, because everybody, once the consideration passes, the seller goes out, the lenders go out, everybody disappears, then how do you really get that protected? So even in those cases, if there is an insurance company which is stepping in and saying, okay, I'll provide the continuity and facilitate the transaction, that can be a very, very useful sort of addition to the process.
Thank you, Deepak. I'm really impressed with how engaged our audience is. So this is a really heavy question, seems very light, and I'm going to bring it to you, Bharat. So should one accept oral information as within the definition of confidential information, within the purview of an NDA, and what should be the length or duration of an NDA? Two questions.
Yeah, so on the I would go back to the point made by Prasenjit, which is that look, all information that is being exchanged is confidential information, so that should include oral information as well. You shouldn't really, in my view, need to distinguish it, because yes, it's difficult to track how information is already. You wouldn't exclude it. Let me put it that way. So it would really generally get covered under the definition of confidential information. Length, typically common law confidentiality continues until the information retains its nature of confidentiality. But often people again look for the clean break and would have a 2-year time frame typically for that for that to terminate. But very often you don't actually have a termination in the NDA as well. It just ceases to be confidential by its very nature.
Thank you. So I think I'll just take the last one since we're running out of time. And I think we have a question from the former CCI chairman who's part of the audience. And his question is that since the CCI came into being, can somebody share what the experience has been with the involvement of CCI on M&A transactions, and what's the experience of the panelists? So is it positive, negative? And I know it's a loaded question with him sitting there and listening to you. But Sundar, that's for you.
Sure.
That's from Mr. Dhanendra Kumar.
Yeah. No, so I mean, I think, I mean, when the CCA was first put in place, there was a lot of uncertainty. People thought about it as whether this is going to be an added level of regulatory approval, uncertain timelines. What we have seen over the last, call it, 5+ years since CCA has come in, increasingly we have seen the response time to be really remarkable. I mean, most of the straightforward transactions have got approved anywhere between 2 to 4 weeks in general, right? I mean, that's pretty remarkable, and I would probably say this is probably one of the fastest response times, even when you compare it with globally. So, I mean, we have been extremely positively impressed by the response time. Yes, there will be some transactions which are more intensive from a competition perspective, which tend to take a little bit more time, which is expected, which is the case. But straightforward transactions are getting done fast. The pre-filing consultation which CCI does, that has proven to be immensely beneficial for a lot of people. A lot of clarifications come out of that process. But I mean, I can sort of say for sure, I mean, when you sort of think about the various regulatory approvals which you need for a transaction, CCI is arguably amongst the quickest of that lot today.
Thank you. Thank you. So I think that's getting us to the end of our webinar. And just as we end, PC, can I request you to just summarize 3 takeaways before we get to the end?
Well, again, that's a tough one because so many interesting points have been discussed today. And to summarize in 3, I think takeaways, I think I will bucket them in 3 categories. I think the first one is preparation. I think in life, more often than not, is the preparation which is the key. And M&A life cycle is no different. I think right from getting your commercial objectives, if somebody asks what we should do, asset deal or share deal, unless your objectives and vision are clear, how will you determine which path to embark on? So get your commercial and strategic objectives clear. Second is get your internal team going, your set of internal advisors, your CFOs, accountant, the right decision makers, and external advisors. That's line them up at the earliest because that will be critical to have their inputs. And third is the management time. Management time is often undermined, as Deepak had mentioned. I think please get that also into account. Second bucket would be the document being the term sheet, not a document to be trivialized with. Many people often discuss that, well, it's a non-binding document, why should we care? Well, if you overcommit in the exuberance to do a deal, you will have to eat a humble pie, because if you go back on your words tomorrow, it doesn't leave a very good impression and people will not trust you. And the seller will also start opening up the term sheet. So very carefully think through the term sheet when you draw up. Get your carve-outs going when you agree to a confidentiality agreement. Make sure its carve-out are properly addressed. Your non-solicit is not too broad, and it's well kind of documented. The last takeaway, I would say, the pitfalls, which we have, I think, briefly touched upon. The most common pitfalls are you jump into the transaction without really a clear structure. You kick the issues down the road. You don't want to face up to the key issues, the deal breakers, thinking let's sign up to a term sheet and let's go forward and deal with it. That's not how it works. If you know you are going to propose a deferred consideration model, that's going to come as a rude shock to a seller. The seller doesn't want to hear that. That's a new deal there for the seller. Similarly, if you have an earnout, please propose it. If a buyer wants to, for example, buy 100% of a telecom company, it can't, because it's capped at 49 and the automatic route. If you don't even bring it up, it's a futile exercise, a term sheet. You must address these issues. Last but not the least, the right balance between an overly granular term sheet and a superficial term sheet. Strike a right balance, get the advisors in early on, follow the middle path, tread carefully, and you should be fine. Over to you, Hegreev.
I think, PC, you've summed it up very well. Thank you very much. Very insightful. So before closing, we have a poll slide for the audience, and I'd really request each of you as part of the audience to respond to the poll slide on your screen and provide your feedback to the webinar. We take this very seriously, and it's part of our continuous improvement program. And then to conclude, we will be looking at these results. Finally, I'd like to thank each of our guests for sharing the experience and expertise with us today. Deepak, Sundar, and Karan, thank you very much. Without you, this webinar would not have been possible at all. Each of you were just outstanding, and thank you very much. We are truly indebted to you. To our audience, I hope you found the webinar interesting and useful. I hope it was worthwhile for you to invest your time. We certainly enjoyed bringing it to you. After the webinar, we will be sending you on email today's presentation materials and a link to the webinar. We will also be asking you for your feedback, your comments, criticism, improvements, and of course, compliments. The form will take you less than a minute to complete. Please do not hesitate to contact us regarding any matters arising from the webinar. Our contact information is below. And with that, thank you very much, all of you, for your attendance, and we look forward to being of service again in future webinars. Thank you very much.
Thank you.
Thank you.
Thank you so much.
Thank you.